Hello. Today we're here to share some great news regarding the Plymold 401k plan. If you like free money, and if you'd like to retire eventually, you'll love what we have to share over the next few minutes. Plymold is excited to announce that effective May 31st of 2021, they will start an employer matching contribution into your 401k account. Very simply, this means that Plymold will be adding money to your retirement account. Why? They want to help you get to a successful retirement. So let's get into the details of how it works. It's pretty simple. Every dollar you contribute from your own paycheck, up to 6% of your earnings, Plymold will contribute 50 cents into your retirement account. Let's look at an example. Let's say your annual income is $40,000. How much will Plymold put into your account each year? Well, we know this is a matching contribution, meaning you need to contribute to get the match. If you don't contribute, neither will Plymold. But what if you contribute 3% of your earnings? Well, over the course of the year, 3% of $40,000 is $1,200, or around $50 a paycheck. Plymold is going to match 50% of that, or $600. This match will be put into your account each and every paycheck. But can you get more? Sure can. Plymold will match up to the first 6% you put in. So, if you contribute 6%, Plymold will put in $1,200 over the course of the year. What if you contribute more than 6%, say 10%? Well, Plymold would still put in $1,200. Why? Because the match caps at 6%. This doesn't mean that you shouldn't save more than 6%. In fact, financial experts say you should save at least 10% of your income to be on track for a successful retirement. Okay, here's the most important thing. If you're contributing less than 6%, you're leaving free money on the table because you're not getting the full match. Every year, tens of thousands of American workers say no to billions of dollars of free money. In fact, 1 in 4 people aren't contributing enough to get all of the matching contribution their employer is willing to put into their retirement account. Don't be that person. But why does it happen? One big reason is that people don't understand how big of a difference it can make. If you're 30 years old making $40,000 per year, the 3% match from Plymold, call it $25 per paycheck that they're looking to put in for you, could grow to almost $150,000 by the time you're 65. I'll say it again. Don't be the person who says no to $150,000 free dollars. It might feel like small potatoes now, but over your working career, it'll make a huge difference. We'll show you another example in a couple of slides, but first, we'll talk about vesting. Vesting is the one rule that you need to be aware of. Here are the important things to know. First, you're always 100% vested in the money you put into your account. Whether you're with Plymold for 25 days or 25 years, every penny you contribute is your money, and you can take it with you when you leave the company. The employer contributions follow what we call a vesting schedule. Simply put, you have to be with the company for a period of time to earn the right to take the matching dollars with you when you leave. In the Plymold plan, you'll vest in the matching contributions over a 4-year period. Your vesting starts from the date of your employment, not from the date that you start receiving the matching contributions. So once you've been with Plymold for 4 years, maybe many of you have, you'll have earned the right to keep all of the free money that they're going to be putting in. Remember, the schedule only applies to the employer contributions, not the contributions that you put in. All right, back to the fun stuff. How's this going to affect your retirement? Let's say you're 35 years old and make $40,000 per year. You're planning to work until you're 65, and during that time, you contribute 6% of your earnings, and you have a 7% rate of return on your money. Well, based on these assumptions, you'd have roughly $320,000 saved in your account at retirement. Not bad. But how much more could you have if Plymold matched half of your contributions? Your account projection would go from $320,000 to over $480,000. That's over a $160,000 increase thanks to the matching contribution from Plymold. I'll pause for a second to let that sink in. It's pretty amazing. You might be asking, how can I change my contribution? Glad you asked. Start by logging into your account at principal.com. Click Login in the upper right-hand corner to get started. On your homepage, click the Contributions drop-down, and then click on Manage Contributions. On this page, you'll see all of your current contribution details on the right side. In this example, you're currently saving 3% of your paycheck. On the left side, you'll see 3 drop-downs: pre-tax, pre-tax catch-up for those age 50 and older, and Roth. Let's say you'd like to increase your pre-tax contribution from 3% to 6%, so you can get the full match from Plymold. Simply enter 6% in this box, then click Review and submit changes. You'll come to a screen with a summary of your new contribution elections. If everything looks good, just click Submit Contribution Changes and you're all set. One last thing on contributions. Let's say you're currently contributing 3%. You'd love to get to 6% right away, but let's face it, money doesn't grow on trees. The best strategy might be to slowly increase your contribution over time. There's a simple way to do this automatically on the Principal website. The feature is called Automatic Annual Increase, and you'll find it in the same contribution section we just reviewed. Just under the section where you enter your contribution percentage, you'll see this feature. Here's how it works. First, click it to On. This dropdown will appear. There are 2 questions to answer. Bump my contribution by, let's say, 1%. This tells the system to increase you by 1% each year on January 1st. The second question is, when should it stop? Let's say it should stop when I get to a 12% contribution rate. After you click Review and Submit, you'll see a summary like this. What you've asked Principal to do is increase your contribution 1% each year on January 1st. It will keep happening until you get to a 12% contribution rate. Coming from a 401k nerd, this is one of the most powerful tools there is. Why? There's a couple reasons. First, you can set it and forget it. Most people who set this up don't notice the increase each year. It happens at the beginning of the year when your paycheck tends to change anyway because of changing costs for other benefits. Also, a 1% change is only around $12 per paycheck if your income is $40,000 per year. Second, if you do this, it will make a significant difference in your retirement. It might even be the determining factor of whether you're able to retire or not. Many people don't save enough because they're overwhelmed by how am I ever going to save enough? I'm telling you, no one saves for retirement all at once. It's a little bit at a time for a long time, and it adds up. I'll show you an example to prove it. Here's Philip and Diane. They both started saving in their 401k plan at age 30. They both began at a 6% deferral rate. They both had the same salary and same investment return throughout their career. The only thing that Philip did differently was increase his contribution by 1% each year until he reached a 12% deferral. Diane kept her deferral rate at 6% all the way through. At age 65, Philip had over $650,000, compared to Diane's $370,000. Philip had over $280,000 more dollars saved for his retirement by slowly increasing his contribution 1% over a 6-year period. So hopefully you can see how exciting of a change this is and how impactful it can be to your retirement. If you remember just a few things from this, make it these. First, don't say no to free money. It will make a huge difference in your retirement. Second, if you're not saving at least 6%, increase your contribution as soon as you can. Don't leave that free money on the table. Third, if increasing your deferral to 6% can't happen right away, that's okay. Using the automatic annual increase feature can help you get there slowly over the next couple of years. Changing your contribution or setting up the annual increase takes just a couple of minutes on the Principal website. But if you'd prefer, you can make these changes with a quick phone call to Principal. Jot down this number and give them a call. All right, last item, I promise. I hope the last few minutes have been helpful and exciting. I've said it already, but this is really exciting news, and if I did a good job, I hope that you're thinking about what this means for you and your loved ones. Maybe you're thinking, hey, with a couple of small changes, and with the additional money that Plymold will be putting in, retirement could really happen for me. I hope this is the case, and a short video like this is great, but remember, The action is what matters. Like anything else, it's all about making a plan and sticking to it. In that spirit, Plymold is excited to offer personalized individual retirement education meetings with Principal on May 24th and 25th. Here's how it works. You'll have the opportunity to sign up for a 30-minute one-on-one discussion with a retirement professional from Principal. These meetings are over the phone, and Plymold will have a room set up at your location. You can even invite a spouse or a loved one to join the phone call as well. During the meeting, you can ask questions and get answers to things like, am I saving enough? How do I select investments? Or how do I get on track for retirement? The objective of these meetings is to determine your goals, understand how much you need to save, and create a personalized plan to help you stay on track. Needless to say, this is important stuff and certainly worth 30 minutes. So how do you sign up? Look for a communication in the next few days on how you can reserve your time. I want to thank you all so much for taking the time to join us. Have an excellent